Mandela once quoted, education is one of the strongest weapons that we can use to change the world. So let us try to gain more and more knowledge to sharpen this weapon with every passing day. I am Mehek from AIIOBF, and I'd like to invite our speaker for the day, CA Sumit Dhadda ji, and all the participants to AIIOBF's CEP webinar on CLD and Valuation under Income Tax. Before we start with the webinar, I'd like to give a brief introduction to our speaker. Sumit sir is a practicing chartered accountant who secured a gold medal in CA inter exams. He's an insolvency professional and a registered valuer under SFA from IBBI. With over 10 years of experience in multinational audit and accounting firms and statutory audits, Indian accounting standards, valuation and risk management, he's a managing partner of DLS and Associates LLP, an independent director and audit committee chairman of a listed company. He has been serving as a faculty at AIIOBF from the very starting, I must mention this point. And today we are pleased to invite him for becoming a speaker on today's webinar. And before handing over to you, sir, I'd like to request the participants to make full use of the Q&A and the comment box and make this session a bit more attractive. Thank you, sir. Over to you.
Thank you, Meg, for the warm introduction. And good afternoon, everyone, my fellow colleagues. I not call anybody as a participant. I call all as a colleagues because we all are valuers, and we need to understand now the IBBA is pushing too much on CPRs, and we need to also understand CPRs because things when they change and if you don't take notice, it makes huge impact. And recently, IBBA did a peer review of various reports, and they were surprised to see a lot of changes which were suggested in September 2020 disclaimer report issued by IBBA that have not been covered in many reports. So we cannot give an excuse that I have not updated with latest guidelines, or I was using the report from last 2 years and nobody objected. So we need to update our reports based on the recent guidelines issued. These are not recent now. It is almost 9 months now. These have been issued by IBBA in September 20. And key focus was on new things added like premises, base of value, your intended users report, and what caveats we should give. So we need to go through, and we also will go through after this caveats income tax valuations, which is becoming too much challenging these days. Challenging not because it is complex, challenging because we valuers are always doing a right job. The department has always taken a strong stand. What they do not understand, they always qualify. So ITT has slapped department many times that you need to give credence to the law. You cannot ignore law, and you cannot do what you like. We'll touch base some case laws which will come in favor of the value fraternity. So IBBA has issued guidelines on use of caveats, limitation, and disclaimers by registered valuers in valuation report. And before we begin session, let me give you a caveat. I am not responsible for my views expressed. Limitation, I'll be sharing whatever little I understand from the guidelines issued by IBBA. And disclaimer, views are based on guidance issued by IBBA and the PDF file hosted on IBBA website. So if there is some typo errors in the website, I'm not responsible. So this is just to give you a glimpse what IBBA wanted in their CLD guidelines. Now imagine if you read any audit report, and in audit report we are writing, let's say you see a note, auditor says debtor in inventory has been taken on the basis of certificate given by management, and creditors and liability have been taken again as certified by management. I I have not done any work on it. I relied on management. What do you think as a reader will give you a comfort? Will you be relying on the report or you will shrug away the report? I was talking to one of the valuer and he gave a classic comment. And he said, if I read such kind of disclaimers, I get a feeling like the left side of the balance sheet has nothing right in it and the right side of balance sheet has nothing left in it. So I cannot give disclaimers or warnings or limitations for those things which is given as a duty to me. So as an auditor, my duty is to check these things. I just cannot rely on certificates of management. So I cannot push my responsibility just by taking an MRL. The client has given a representation that this is a true value of inventory. I need to do my diligence. So the point started rolling when Income Tax Department raised an objection in one of the merchant banker report based on the disclaimer clause. So ITT Delhi has opined that if I review the disclaimer clause, it looks like professionals are not doing their job. They are just putting entire blame on the management and making the report not usable at all. So we understand what happens in a DCF. We work on a projections, try to work cash flows and give the value. If I write in a report that cash flows are not at all checked, and if something goes wrong, I'm not at all responsible. I have not looked into cash flows at all because these are prepared by management. So my entire foundation of DCF, which depends on cash flow, if I have not tested anything and I am giving a disclaimer, it defeats the purpose of the report for which it should be given. So in this specific case, the authorities pointed out that whenever we use DCF method, it is always possible for a company to decide what price I want, and I can do a reverse engineering. We can do a tailor-made projections to get the desired value. And specifically, when management is giving a data and valuer is accepting without even doing any testing. So what was the disclaimer given by merchant banker in the report? And the disclaimer, he said that we relied upon assumed without independent verification. Here the income tax has a challenge. They say at least verification should have been done by you. Accuracy, completeness, for sure you cannot hold valuer liable because it is not audit or investigation. But verification has to be done by a valuer. And merchant banker says we decline any responsibility should the result affected by lack of completeness of truth of such information. And we all understand projections are the baby of management. We do not make it. We may calibrate the projection, but we don't prepare the projections. And for projections, it is always said more fiction is written in Microsoft Excel than Microsoft Word ever. You can make any projections. Projections is in management hand. Last 4 years, we have not seen any startup valuation we should have done. They could have reached at least 50% of the estimated projections in next 2 years. Because whenever management make projections, they want to sell shares at higher price. They want to dilute the shareholding at a lower value. So to dilute shareholding at a lower value, they need to have higher price. And to get a higher price, higher projections. I remember we are doing one valuation in 2020 of a startup who deals in selling sports shoes to various school students on an online basis. One of the sports personality is a brand ambassador of that. So 2020 they've given a projection and they did not achieve that. 2021 March they again came back to us for valuation and we asked a simple question. You have given a projection last year, which we did not even achieve 50% this year. Current year also, you are giving the higher projection. What gives you guarantee or gives you assurance that you will achieve the projection? And see the funny logic given by management. He says, sir, last year was complete lockdown. So kids were at home. So shoes were not used. So that makes sense. I said, that is acceptable. But how does it justify that next year your sales will at least be double? So, sir, since last year kids have not played, this year lockdown will open. So they will play double because they have not played last year. So this year parents will not stop them from playing extra. And this was the argument given by the client. So you can never argue with client. So we said this logic does not gel down. But then he says this year or next year onwards, people will start buying more and more shoes. So projection can always be babies of client. If I do not agree, then I have a choice of increasing my cost of capital. That is in my hand. Because if I tell client you cannot do business, he will not give his business to you. He will move to some other consultant. But having said that, it does not mean I should blindly sign on whatever projections he is giving. What IBB and regulator will look, what questions have we asked on these projections? Are we testing some logics or not? So that is most important. And then ITT question here, and they give an order against the company, rejecting the valuation. And they just said that by reading this disclaimer, we are of the opinion that merchant banker did not did anything reflecting his expertise, except mere applying the formula. So which is not expected from a professional, because if it is a matter of applying formula, any graduate can do that. What is expected more beyond the numbers? What is the process which you arrive? And they also quoted, had you would have done independent inquiry, at least on test basis, we could rely on the report. But since you have not done any inquiry, even on test basis, we reject it. Then they asked many questions after this report. Why you have taken beta as 1? Why not any specific calculation of beta? Why have you not taken specific study of sector for choosing terminal growth rate? You just cannot take blindly 5% without adding any base of it. So normally we do understand, since we all would be using DCF, we all understand 2 to 5% is a range we take. But it is a subjective. So if tomorrow they come, I cannot give a disclaimer in report that since management have given a 5%, so I'm relying on 5%, or I cannot estimate the future, so 5% looks reasonable because everybody else is taking. That stand will not hold good. So we need to test what is a sector specific study happening. Then this kind of things can be addressed. So this gave an issue in IBBI. What should we do on the disclaimers given by valuers? Because IBBI understood that it is a starting point. The profession is still evolving. And if we set this principle right, later on when this valuation reports will be allowed in other acts, such disclaimer may not hamper the reports. So see, it is not only in India, globally, it is one of the biggest merchant banker reports in USA, and they have given one disclaimer standard that if there is anything wrong in the report, nor we guarantee it is free from error. If you tell a reader that it may be having error, his confidence shakes. Similarly, in Committee of Experts report, which was published before bringing the new draft values bill, they have mentioned there you should not put disclaimers which has a potential to dilute the responsibility of valuer. Prince, can we unmute Prince? Let me check. Let me see if I can do. Yes, Prince. I think you raised hands. So if you like to speak, feel free to speak. Okay, maybe due to error. So the committee of expert reports issued by IBBA says you cannot put any disclaimer which dilutes your responsibility. So as a valuer, my responsibility is to give fair value based on certain data. I cannot give a disclaimer that without any data, I'm giving information, it may be considered as fair value. Or I valued something, but I have no expertise. Take for example, I have been appointed to value IBC company having diamonds as a inventory. So I just cannot say I have no expertise of diamond, but still based on market rate or cost inventory sheet of the company, I've given a report and I give a disclaimer that I'm not competent to value diamonds. You cannot do that. If I'm putting it, I'm diluting my responsibility. So even if you're not expert, but if I'm giving a value, I take whole responsibility. And intent of IBBI is that your reports should be able to test into the judicial proceedings. Here there are two different views, and which I appreciate both the views. One view is when my report is an estimate, why do you want my report to get tested? Because it's estimate. Estimate may go wrong, or my estimate may be much differ from your estimate. We both may be right in having our estimations. But then department views is always whenever any transaction is happening, a buyer or seller is relying on your estimate. Though they are free to take their own calls, but if as a professional I'm giving an estimate based on certain numbers, certain standards, the result should not be too different. So our report should be capable. And before this September 20, none of the reports were able to test through the judicial proceedings because we always give a disclaimer that I am not responsible for any data presented and I'm only responsible to the company. So this was always out, but now we need to have disclaimer. So September 1st, now onwards, any valuation which we are doing, either it was before September 1st assignment or new assignment, now all reports should contain those caveat limitation disclaimers given by IBB on September 1st. And Rule 8 of valuation rules mandates what extent you should give your caveats or limitations disclaimer so that it should not limit your responsibilities. So there was a committee of experts by these gentlemen and all RVOs were consulted before publishing these guidelines. And all RVOs are mandatory, supposed to ensure that your section 8, your rule 8 requirements are covered in report. So now I know many RVOs, when their peer review is done, for them rule 8 subsection C, that becomes a checklist. So if you go to rule 8 subsection C, they've given certain broad headings that these should be covered in valuation reports. Whether you are SFA valuer, plant and machinery, or land and building valuer, or whether you are issuing normal share issue report or IVC reports, these have to be covered in your reports. If you are not covering Rule 8 subsection C topics, it consider as you have not captured the minimum requirements given by IBBI. There is one more guidance. even if you are not giving report under Companies Act or under IBC, but you are giving report as a registered valuer in any other law, then these reports should contain these broad headings. So these broad headings starts with, these were always there earlier. Few things which added recently was, earlier in the before 2020 September, we were not supposed to mandatory mention base of value or premise of value. Optionally, we all were doing it, but after this, we need to give specific para on this. What is the base of value? What is the premise of value? So if you can link to either IVA standards, or you can link to ICRU standards, which is the RVO which is issued standards, then it will be advisable. Normally, we always write restriction use of report. Now they mentioned you should write who are the intended users of the report, which is almost like restricted user. So here you can put your liability fixed, that my users of the evaluation report can be only company or committee of creditors in case of IBC. This will help in our favor. So these 3 bullet points have added recently in September 20, and lot many reports do not mention this specifically, and IBBA reviews it, so they look for these points specifically. So take care of these 3 points at least. Apart from these points, we have 2 more points which are added. That is, you need to give business details, ownership, and if possible, we need to give some business background, that what is their exact nature. Just writing one line that this company deals into trading may not be sufficient. So we need to give what is the nature, is it export, import, or what kind of basic products they deal in. So little bit para you can ask for company to give this detail. Ownership is mandatory now. Earlier voluntary we all used to give, but now they have put mandatory. So you need to give either equity shareholders details, if they have preference shares also, so preference shareholder detailing also, that should be submitted in report. Now significant assumptions was not there earlier, they have added this time. This we need to take specific care. If I'm relying on, I'm doing a net assets method valuation, which many of us do, and we have a small portion of land in it, and client is reluctant to get a land valuer, IBA registered land valuer in it, because at times client resists that why should for a small piece of land I get a valuation done. So he don't want to get a valuation done. If he don't want to get a valuation done, so I have to somewhere safeguard myself. So I'll write in significant assumptions that value of this particular asset has been taken on the basis of circle rate as discussed with management. Then you can always write, though we have insisted for or asked for independent valuation report, but client is not able to provide the report. So we have relied on the circle rate based on various city and concluded accordingly. If you do not give this, that means you are hiding a fact. But this is the most significant assumptions in your net assets method. And I cannot take a call of valuing the asset for which I am not registered. So if I am SFA valuer, even if it is a plain vanilla land, if it's a just plain land, I cannot still take call that I will do a valuation, because client will always argue. Client says it's just a barren land, multiply the circle rate into the area, what else you want? And he will always say the other valuer will also do the same. We should not step into the shoes of other fraternity. If I am not land and building or plant and machinery valuer, I should not take owners. But these are practical considerations. If client is not willing to get these valuation done, just give a mention in signature assumptions, and we need to close the engagement. So these are the 5 changes which happened in the reporting structure, which was not there earlier. Caveats were there since inception, that we have a right to mention caveat, limitation, disclaimers. We also now need to write what are the procedures involved while doing any valuation. Whatever approach you take cost, income, market, procedure remains the same. So we need to now write on what analysis we did on their financials. So if it's a existing company, have vintage of 5, 10, 15 years. So you have enough past data to realize. So you need to make some assessment. And if you recall, in our syllabus of exams, you had common size vertical or horizontal assessment. That analysis can come handy in this, that you reviewed the projections, check, reviewed the past data also, and compare projections with past data. But that is a ultimate benchmark of how you rely on for existing company projections vis-a-vis past. For a startup, it is not possible because you don't have past data. But for normal industry, it is always advisable to do a backtesting check. Industry analysis needs to be written. Now we need to give little bit information on industry analysis. There are certain websites like IBEPF, or if you Google out certain websites like Chamber of Commerce, PhD, they give short and brief analysis on that industry. So it is better to take data from there, give reference in a report that we copied this industry data from this particular website or this report. So that gives authenticity to your analysis. If you are using multiple approaches, markets, you can write a comparison. Normally for small companies, it is not possible much, but for big companies, it is always acceptable. Just let me see one question. If so, Mr. Ramshankar Verma, would you like me to unmute you, because I need to understand 2-3 things before I answer your query? Let me unmute you if you are comfortable. So, Mr. Verma, my question.
Yes, sir. Can you hear me, sir?
Yeah, I can hear you, sir.
Sir, in last slide you told that if piece of land is not in, the client is not willing to get valued the piece of land, we should mention the significant assumption for that he is not willing to. But if that land is not in the scope of work, then is it necessary to mention that assumption?
No, if it is not in my scope of work, then it is not my assumption. I am giving I am giving an example where client has asked you to do a fair valuation of equity shares. So you want to issue a fresh shares. He wants you to give a fair value of equity shares, and I am using net assets method. So because he's not giving me any projections, so he's saying take my balance sheet and get me a net assets method. So in that balance sheet, if land value is there, so it comes in my scope because there is an asset. So what I will do is, ideally, I will ask the management to get a IBVA registered value report. But if he is not getting that, so anyways, I need to conclude the assignment, and he will give me a report, either unregistered valuer of IBVA, or if it is a simple land, he may give a circle rate. So then I need to put assumption, because in a net assets method, fair value is, this assumption is strongly challenged, because I cannot rely blindly on client's data. But if client is not giving any independent report, so I need to mention it. But if but take example of IBC, then in IBC for SFA valuer, it is not my scope. So it's not my assumption. But I'm doing entire company, then I need to give assumption.
Okay, sir. Understood, sir. Thank you, sir.
And just to give you background on it also, IBBI is very strict now, and they're asking all RVOs again and again to update your members, not to do assignment of other asset class. So normally what happens is, take example, a land and building valuer will value a company, a building. There are small plant and machinery items, let's say very small, not very big. So what land and building valuer will do? He will tell to the client, let me include this in my scope for supporting the client. And he will do that. Then IBBI has asked all valuers to confirm that you are not valuing any other asset, because a lot of clients resisted and a lot of people give heed to client voice, which is not acceptable. So IBBI is strict on that. So I'm telling you what is practically happening also. So we need to write on what are you comparing. Have you discussed with management? So we always write that all data have been discussed with management. It is necessary. In case of SFA valuer, desktop valuation can always be done. But in case of land and building and plant and machinery valuation, ideally desktop valuation is not permitted, ideally. But if my scope of work is like that, you can sit in your office, I will give you all data. Let's say in case of COVID pandemic, when travel was all stopped, and the client insists that I will give you all online access to the data. You can have a satellite view, or I can put your cameras, something like that. Then you need to specifically mention that this is a desktop valuation. But this cannot hold good in case of IBC cases, because in IBC case, it is mandatory requirement that you need to visit the premises and inspect the asset physically. And this is the reason a lot of SFA valuers do not prefer taking inventory in their scope of work, because my all other assets can happen sitting at home, but inventory I need to physically visit. So that increases my scope of work. But I cannot give a disclaimer in report that I have not traveled due to COVID. So inventory, I rely on client's photo. That may be a big challenge. No issues, Badri sir. Your attendance is based on your registration. So no need if anything is not there. No worries. And you don't, anybody else, participants, no, you are not required to message your numbers also. If you're logged from your link, your attendance is recorded. Now we need to give a positive statement instead of giving negative statement. Now in a disclaimers CLD, we need to give affirmative statement that whatever, and this causes responsibility on valuers, that whatever information and assumptions management has used, it has been appropriately reviewed. Inquiries have been made. So this casts responsibility on a valuer that whatever management has given assumption, you have reviewed it, and inquiries have been done considering industry and economy. So take classic example. If someone comes and says, let us do a valuation of hotel industry, or a startup who delivers in hotel industry. Now we know for next 1 or 2 years, the travel and hotel segment are hit badly. So you cannot expect outlier sales in first or 2 years. Maybe third, fourth, fifth year, things will be normalized. But we need to have industry assumption and economic movement before accepting such reports. And you need to also write, and this last affirmation has a little bit challenge. you need to write that you have adequacy of information and sufficient time for carrying out the valuation. So it cannot happen. Your appointment date is 11th of July and your valuation report is 12th of July. And when you're using DCEP methodology, because then it questions that do you have sufficient time? Because in 2 days, you need to review the projections, ask inquiries, make a independent analysis. So is this sufficient? So you should always try to have some time gap between your date of appointment and your date of report. RV always have right to demand whatever information you want relevant for valuations, specifically on challenging the projections, and the company has to provide. RV cannot make the projections or cannot assist in making the projections in India. Globally, RVs take this assignment also for the same company, same assignment. They can do a preparation of projections also or assist the management in making the projections. But in India, more on independence issue, this is not allowed. The only right RV has is if we disagree with your projections, I can always tinker my cost of capital. I can always tinker terminal growth rate and the assumptions I'm making in terminal growth rate if I'm not happy with the first 5 years of projections. You need to give mention now, which normally a lot of reports are missing. What is the impact of unlisted companies' valuations? So in case of unlisted company, they always have a marketability issue. So we need to mention something on marketability. Or if you're valuing for minority or majority, that impact you need to give detailed assessment. Now they have defined what exactly IPPA mean by caveats, limitation, or disclaimers. So caveats are just like you are giving a warning or giving a caution signal to the user of the report that if you want to rely on the report, these are my certain assumptions which I want to highlight to your knowledge. You may take call after reading them. So caveats are always warning which you give. Limitations are those which restrict your scope. So take for example, if I am a registered valuer and I'm getting a assignment of IVC, but to arrive at a fair value, I need data from client. But client says last 3 years data not available due to dispute with management or promoter is not sharing the data. So if you're not having a data of last 2 or 3 years, so without data, whatever value you are arriving, it is restricting your scope. I cannot leave the assignment of IBC just saying because company has no data, so there is no value, so I cannot do the assignment. We need to conclude the assignment because if assignment is not concluded, the committee of creditors will not be able to move ahead in the resolution plan. But then whatever last data available, I'll give it limitation that due to not availability of data last 2-3 years, if the data is available, the value proposition may change. Value may go up or may go down. Now, disclaimer is a mix of limitation and caveat. It serves like a warning, but for an RV, it serves in a positive way. It restricts his responsibility. So he gives a disclaimer that based on what you give or based on what client has given me, this is what I am giving. Here, I'm not committing that I have done a investigation. So take example, I am doing a valuation. Client submits me a property paper. Is it my duty to go to the registrar office and check the authenticity of the property papers, or I will rely on what property papers client has given? So on an idealistic scenario, I can always rely on the property paper given by client. It is not my duty to go to the registrar of land department and say, show me the original records to verify what client has given is the right document, because I'm not doing investigation. So if that document is faulty, you cannot blame me, because I did my normal due diligence. I checked online, records seems okay. You cannot hold me responsible for that. So you cannot write that projections are given by client, so I will not do anything on it, or my responsibility is not there. Your responsibility is always to check the inputs and assumptions. Discuss this point at length. Now they have given, IPV has given certain caveats and limitations which you always write. So you can always write in the report that this report is restricted for particular use. If you use it for other purpose, it can always have not be tenable. For example, if I'm issuing any report at Companies Act, I can always say it cannot be used for any other legal purpose. Let's say for income tax or FEMA, the same report cannot be used. You can always fix your responsibility, that my responsibility is only to the people who have engaged me. So I'm liable to answer to them only. So that way you can fix. You can always write that accuracy is not expected from you, because accuracy is only when you do audit or investigation. You can always give a caveat that whatever forecast results we have put in, they may not be achievable. Now this, somebody can argue, when I'm writing this may not be achievable, then are we diluting the projections? We are not diluting the projections. Here we are saying we tested the forecast. So whatever forecast client has made, we checked. But future is unpredictable. You cannot guarantee that client may be able to achieve that. So take for example, nobody have predicted event like COVID. So all forecast done before 2020 goes for a toss. Even nothing happens like COVID. So client has estimated projects thinking they are the only one who can sell the product. Take example, when COVID Shield came, COVID Shield was the only one selling in India. Now we have Covaxin, Sputnik. So your projections goes for a toss, because earlier you thought you are a monopolistic. Now we have multiple brands. Post-valuation disclaimer always needs to be given, and specifically when your date of valuation of asset and your valuation report is a huge gap. If it is a week, 10 days, 15 days, the liability is very less. But if there is a huge gap, so I'm doing a valuation 1st January 2020, now it is 1.5 years gone. So I need to give a disclaimer that between the valuation date and report date, whatever happens, then I'm not responsible, because it may happen as on 1st January 2020, value may differ, and today there will be a totally difference. So you need to always give disclaimer for this to safeguard. Range of value you can always give. You can always give a valuation range, but mostly in reports client prefer one exact number. So that number can always mention as it is an estimate. And again, you can always mention that it is not necessary. Whatever valuation we are giving, the transaction may happen at that particular point. Because my report gives one number that becomes a benchmark for buyer and seller to negotiate. That does not guarantee that what report I am giving, the transaction will actually close at that point. Transaction may close at below that number or above that number. You can give various other disclaimers that I am relying on representation of the management and third party. So management says this is our list of shareholder. Because what happens in case of list of shareholders, if you go to MC website does not always have the updated list. The list get updated only at the time of filing annual return. Then the list of shareholders changes. But during the time last list was uploaded and during the current period, the list of shareholder may always change. So you can always rely on the data given by client on who are the existing shareholders now. You can always write a report that I have not done any testing on data received from reliable external sources. Take for example, I am doing a DCF valuation, and to take beta, I am taking Ashwath Damodaran's website. So if he has given any data, am I doing validation of that data or blindly relying? So I'll be honest, I'm blindly relying. I will not go and check with Bloomberg what the data is comparable or not, because we rely considering that website as a authenticate source. Did I have any contract with Mr. Damodaran to give me reliable information? Answer is no. But still, we all rely on his numbers, thinking it is a gospel truth that whatever data he is given is a reliable data. So I don't need to perform any procedures on that. So I remember in one of the HSBC report when I was in Middle East, so our auditor gave a disclaimer that I have not, valuer gave a disclaimer, I have not tested the logics used by Microsoft Excel in computing the numbers. And I was actually laughing that what was the need to write such kind of things. And then he says, because we rely on entire on Excel. What if Excel is a bug and one formula might go wrong? So I need to give a caveat and disclaimer that whatever Excel is giving, we are not double checking it. That sounds a little bit too conservative, but that's people have taken. I can always give a disclaimer. We rely that company comply with relevant laws. We have not tested whether the laws have been not complied or not, because it's not my duty to check whether the company has filed GST returns or not, or tax returns or not. Because if they have not filed returns, there will be a content liability. But that is not my cup of tea to check. Just give me a minute. Now, a very important thing they've mentioned, and which IBBA was very considerate to put, you can always give a disclaimer that if I need to give any testimony or appear in front of any authority to present my report or defend my report, you need to bear my expenses incurred for this process. So that puts us safeguard on your values, and it is advised because since IBB admitted this in their guidelines, so they also understand this. We need to put in our engagement letters also that if we need to give any testimony, you need to bear our actual cost apart from the normal fees we agreed. Because this generally comes in case of either minority valuations or in case of wherever you're going for income tax valuations, then department may question. And last 3 years, the department questioned a lot to startup valuers, and NCLT is also questioned. So you can always put this disclaimer to safeguard. Especially in case of IBC, this you can always put a disclaimer that we are not getting updated information. And I'm sure those who would have done IBC cases will agree. Client do not give, because RP do not have any data of old outstanding number of days. You only have balance sheet. The access of computer is not fully available. You don't have data of what is the security deposit or advances given and whether it will be recoverable or not. So if you're not having any data, you can always put a disclaimer. Though you need to do a diligence also. For example, client has given me a list of debtors, but I have no information that how long they are due. But at least if these are corporates, I can just do a Google search, check on the websites of MCA, whether the company is functional, defective, not filing the returns. So we did 2 valuations of daily-based companies. Out of 80 companies, 50 companies, more than 50 companies have stopped filing returns in 2012-13 onwards. So they become different companies. In the balance sheet, they are coming as a good debtors. So bank was giving loan considering them as a good debtors, despite they were not even filing returns. So we have to consider these facts. We just cannot say because client has not given any data, we have no comment. We need to look on data which is available on public. For specifically for plant and machinery and land and building, we have given separate disclaimers in addition to these disclaimers that you can always write. You can always mention that my job is not to verify the title deed of property. It is not the duty of a valuer to check the authenticity of the title deed. Whatever data, whatever papers client is giving, we'll assume these are the true paper. You cannot expect a valuer to go to the respective government department and verify the authenticity. That is one. Second, you cannot put a valuer responsible that whatever reports you have given based on your photographs or based on your drawings, this is my property. To get exact property details, so any buyer cannot hold value responsible for any photographs or sketching or maps he put into the report. To get exact maps, you need to appoint a surveyor, not a valuer. In case of hazardous goods we have in your valuations, you can always either disclaim that in considering the valuation, either you are considering the cost of decontamination also, because to remove hazardous goods, it involves a lot of cost. Even there is not a, you cannot just throw in the garbage. Take example of if you are having a mines or if you are having a chemical factory, you cannot dump the waste anywhere. There is a procedure and it involves cost. So whether have you considered those costs or not in your valuation, you need to mention. And you can always, this specifically for land and building, and maybe if you have a land building valuers in the session, I just want to ask one question. Suppose you did a valuation of a building and a week later, the building falls down. Maybe the foundation was weak, structure was weak, whatever is the reason, the building collapsed. Can we hold valuer as a liable? We are discussing on a logical ground. I am not pointing fingers. I am asking a question because this question IPV has considered. Any valuer who is land building valuer would like to have his views on this. So you done a valuation, give a fair value of a building. After a week, building collapses. Should valuer is responsible? Yes, no, maybe. My screen actually is not able to show whether I'm getting any response or not. Just a second. So I'm not sure if anybody is willing to raise hands or not. So we have Vaibhav Gupta. Let me, Mike, if you're there, can you unmute Vaibhav Gupta?
Yes, sir. Yes, sir. Just a minute.
Or Sudarshan Tavla, whoever is willing to speak.
Able to hear me, Mr. Sumit ji? आप मेरे को सुन पा रहे हैं?
Yes, Sudarshan ji.
Yeah, in my
opinion, sir, you can't hold him responsible because in almost all land and building valuations that we do, there is many a times a clause about the structure stability. Okay, in that structure stability, as a valuer who is not even I am a civil engineer, but even I am not a specialist structural engineer to be able to certify that the building is safe. So perpetually we'll put a clause over there stating that from visual inspection it is looking all right, but you need a structural engineer to certify whether the building is safe or not. And that is the reason why it should be there. Unless when you say it in a week's time, I think it is only sort of metaphorical. But if the building is looking dilapidated, then you can make a statement to that effect when you're doing a valuation. But if it is not looking like that and it suddenly falls, then it's obviously a structural failure, for which you have to say that the structural engineer should have been appointed to look at the structural stability.
Fair enough, sir. I agree your point. Vaibhavji would like, or Sudarshanji, I'm not sure who has not spoken. If you have any other points to add on this.
My name is Vaibhav Gupta. Actually, I was going to say the same thing only. Had it been if at the point of inspection, the building is not looking good, we can write it down on the report. But if it looks fine, and because we have these disclaimers that structural stability, we're not guaranteeing the structural stability of the building. It is the same thing, yeah.
So thanks, Vaibhavji and Sudarshanji. This is exactly what IBB has mentioned in their guidelines, that you should not take RV report as a warranty for the structural stability. You just cannot say RV has given me a value. Let's say for next 1 year, something goes wrong in the building or it collapses. You cannot hold him responsible. You are just giving a value as on date. You're not giving a value on usability, that for next 5 years, you are not giving any guarantee. So that kind of disclaimer can always help you. Now, there are certain disclaimers which they have mentioned you should not give at all. So these are, earlier what we discussed was preferred disclaimers. You can always put in to safeguard. And it is always advisable to either put it as appendix, that these are all caveat limitation disclaimers, so that all things can be captured at one place. Because if you put one line here, one line there, it loses the relevance. But once you put all things at one place, it becomes a strong point for your favor. But certain points you should not mention. Like for example, I received forecast from client, but I have not done any reasonability test or due diligence. That will go against you. In case specifically of liquidation assignments, you just cannot say, I have not physically verified. You need to do that. You cannot give a liquidation value sitting in our office. The desktop valuation is not permitted. Even in fair value assignments of IBC, as I mentioned, you need to mandatory move. Mandatory. You need to physically inspect. You cannot say that I'm not doing any verification of market data. So if I'm taking beta from other company or discounting factor, you need to do some testing on that. You just cannot say Zomato has taken this data, so I will also take this data. Maybe Zomato size is different or Zomato risk appetite is different. So I need to check my data and blindly cannot copy paste. Historical analysis is mandatory. You just cannot say that I will only rely on future projections. You need to do some work on historical. Most important, you need to mention on approaches. You just cannot use only one approach without giving reasons that why I'm not considering two approaches. Valuer is free to choose whatever approach you want, but you need to justify in your report why are you rejecting other reports. You cannot also give disclaimer that this work is done by other expert, so I'm not responsible. Once you are putting any report, any data based on other valuer in your report, you hold full responsibility. That expert is also responsible, but you cannot dilute your responsibility. So IBB has given many wordings suggested, so you should look into that guidelines. Try to align your report along with that report, so with these guidelines, so that once peer review happens, your reporting is always safeguarded, because IBBA will do a peer review testing, and in that case, if your report matches these guidelines and disclaimer, there will not be a big issue. If you have any things to add, anyone has any points to make it, feel free to raise your hands or unmute if you can. I'll allow you. We can have discussion. Then we can move to income tax after this. Let me go to income tax then, if you have nothing to. So another challenge always comes is in valuation of income tax. Let me unmute Mr. Weber. Yes, Weber.
Sir, I just one question.
Please.
Actually, myself is a registered valuer having qualified this IBBA exam. Now there are some valuers who are registered under this wealth tax and who are doing this valuation for the banks. So are these CLDs applicable to them also?
So these CLDs are applicable only to IBBA registered valuer. But
okay,
suppose you are IBBA registered valuer, and now if you are working in income tax or for banks, so bank not necessarily need to have a IBBA registered value report, but then it is an expectation of IBBI that whenever a registered valuer is using report in any other law, he should try to follow these guidelines. So it is insistence on you. For other valuers, it is not relevant at all. But for IBBA registered valuers, it is mandatory. And nowadays, if you see all IBA bank assignments, they are also putting registered valuers code of conduct and requirements.
Okay, sir. Thank you.
Thank you. Now, 11 UA is the most confusing rules. Whenever you read it, every time you find something new in it, because they have put issue and transfer of shares in one bucket in it, and that causes confusion. And after this session, whenever we finish the next 40-45 minutes, we should be able to understand how 11 UA working should be done, what consideration we need to take care when we are transferring shares or when we are issuing new shares. Both have a different formula. You cannot have same standard valuation for share transfers or share issue. Both are different. Should we go for audited balance sheets or unaudited? Or is valuation report mandatory from registered valuer in income tax or from any other valuers? What are the methods? So suppose there are two methods for share issue: discounted cash flow method or net assets method. Is the choice of using the method with income tax or with the client? And what are the gray areas which are not still solved as of today, which cause a lot of concerns in 11 UA? Before we go to 11 UA basics, try to go through this problem based on whatever little understanding you have. Just read this problem and think what could be your logics. At the end of the session, we should be able to have clear answers to these questions. So for example, a company wants to issue new shares to Mr. X, who is a resident, and Mr. Y, who's a non-resident. So we want to issue that shares. My fair value comes at rupees 15 based on 11 UA formula. That is the fair value coming. Can the company issue shares at rupees 10 to both the parties? Because we normally make allotment at same rate generally. So if I issue at 10, what are the implications? And if I issue at 20 rupees, then what could be implication? Because my fair value is coming 15. But if I issue at 20, what is the implication? And why all valuers who are working in Companies Act need to understand the linkage between Companies Act and income tax? Because in a Companies Act, I would always like to go for fair value. But what is the problem? Client says, my fair value in income tax and Companies Act, if it has a huge difference, I should not have a income tax angle. So that tax liability, we need to plan in advance, think on all the angles, because I cannot, as a professional, client will expect me that I am a registered valuer of Companies Act, but I should also have knowledge of valuation principles at income tax. That is one challenge. Anybody can quickly write on chat what could be challenge if I issue at 20 rupees. Any thoughts? Or is it fine? And we are talking only on income tax purpose, not in any other law. Any thoughts what may happen if we do a valuation, rupees 15 coming, issue shares at 20? Applicable tax will come to whom? Issuer will be taxed. Now that is a big challenge. No company would like to pay tax. If the holder pays tax, company is no problem. So here, company will always push you that either get my value at 20 or get my value at 15. Because if I say that as per Companies Act, my fair value is coming 20. So client board will say issue shares at 20. But if as per income tax, fair value is coming 15, then there comes a challenge. So this 5 rupees becomes taxable in the hands of issuer. So which becomes a challenging scenario. Now take another example. In the same example, we just changed the fair value to 6 rupees. Now instead of fair value of 15, value is 6. Then how much will be taxed? If I issue shares at 20, 14 rupees will be taxed. So here my fair value is coming 6 rupees. I am issuing at 20 rupees. My face value is 10 rupees. So how much will be taxed? It will be 14 rupees, 20 minus 6, or it will be 10 rupees. So it will be 10 rupees. It will not be 20 minus 6. So up to face value, there is no taxability. More than face value, if you go for a higher premium, that differential will go for taxability. So this we are talking of issue. Now comes a question of transfer. When existing shareholders wants to transfer between two shareholders, if my fair value is coming at 150, so rule 11 UA gives me a formula. I worked out that formula and we are getting 150. And if I want to sell at 100 rupees, now think practically. Today, due to stress market, due to COVID reason, a client is in genuine need of funds. So he is willing to sell at a distressed price. So he is finding a buyer who is willing to buy at 100 only. Though the fair value is 150, but he is giving 100 rupees only. What are the implications to buyer and seller? or there are no implications? Will there be any implications, or it is fine that whatever transaction is happening and it is unrelated party, that can be acceptable? So here 11 UA, always note, 11 UA will always give you minimum price. 11 UA for transfer always give you a minimum price. 11 UA for issue will always give you a maximum price, because if for issue my price 11 UA gives me 15 rupees, that is a maximum price I can issue without having tax implication. And in case of transfer, 11 UA gives me 150, that is the minimum price without having tax implication. So if I sell at 100, I need to give, if I sell at 100, the buyer and the seller both need to pay tax. So I can conclude the transaction at 100 because this is the actual transaction happening. Buyer is only paying me 100, but then capital gain when be computed, seller need to book 150 as a selling price. So his tax will be calculated at 150, and the buyer also has to pay gain on 50 rupees extra, because this is the value of property he got without paying consideration. So 50 will be treated as taxable income for buyer also. For 200, if you sell, whatever price you go, it is fine. If you sell more than this, they have no implication. But if you are selling less than it, you both need to pay taxes. Now, what balance sheet we should take? What is the date of balance sheet? Now, there is a rigid law. Once we read the law, and most of you would have read this law also, practically does not make sense. Practically does not make sense. What does the law says? So I'll just give you a verbatim. Law says, if you are doing a transfer of shares, so I'm doing transfer today, I need to have audited balance sheet as on today's date, audited by statutory auditor. So if I'm doing, let's say I'm holding Paytm shares and I want to sell 5 shares of Paytm. So law says go and get a audited balance sheet of Paytm as of today's date. Do you think Mr. Vijay Sharma will honor my request that Sumit want to sell 5 shares, so give him a balance sheet? Nobody will listen to minority at all. So this law cannot be complied, but this is the law. So practically, people go nearest to the date of sale possible. In case of issue, it is relaxed. In case of issue, they say, if you can get a balance sheet as on the date of issue, it's fine. If you cannot get on the date of issue, then go for last audited balance sheet approved in annual general meeting of the company. But this last para, last 4 words, approved in the AGM, causes a lot of problem. And see the typical problem in the example. Take for example, we need to issue shares on 30th June. So we have quarterly financials unaudited as on 30th June. Law says get a audited one. So 30th June, I cannot get audit for whatever reasons. Then I have 2 financials with me. March 2020, because that is 3 months old financial, which I just got audited. And I have March 19 financial. March 2020 financials, my AGM happens in September 20. So technically speaking, then I cannot rely on March 20 financials I need to go on March 2019 financials, which does not look common sense at all. Because why should I go 1 year back, whereas I have latest financial available with me? But if you read the particular section, particular rules, this is the language. So it has been brought to the notice to IBBI, to CBDT many times, that this is not a practical solution. You cannot have same balance sheet, audited balance sheet same day, or you cannot expect that the previous balance sheet should have been approved in AGM, because mostly AGMs happen in September of all private companies. So technically, March 20 balance sheet becomes redundant. Then they verbally admits, yes, this is not the right approach. Intent was not this, but there is some drafting challenge. We will review this. From last 4 years, I am hearing in various conferences that they will look into it. But as of now, they have not actually taken any amendment on this part. So if I go strictly by law, my fair value becomes 100, strictly by law. Practically, we have discussed with various big firms, big law firms who do big transactions. They always take March 2020 financials, because they say practically you cannot make a condition where a company loses, because a company cannot issue shares at less value, because 125, which is the most nearest and most relevant. That's the intent a lot of people have taken. And my personal view is always, I will always take 125. Even though the law may have a different view on it, 125 makes logical. Now, why this Rule 11U become important? What was the loophole here? There was a loophole in this law earlier. So take example, we open a company in 2001, put 5 lakhs each, and made a purchase of land at 10 lakh rupees. In Indian IGAP balance sheets, we put land at cost also. Even in IFRS or Ind AS, I will still put land at cost. But especially in IGAP, what happens was, if I need to sell my shares, I can sell the land at 10 rupees book value, even though this price of land would have been 1 crore rupees. It would have appreciated 10 times. But in terms of Rule 11 UA, we always use asset minus liability at book value, transfer land at transfer shares at rupees face value. So this was a lot of tax evasion was happening. Supreme Court said it is a tax planning, and if you think, and they give a strong case in one of the interesting case law where they mentioned, if you think this is a tax evasion, it is up to you to plug the loophole. Assessee will use whatever is beneficial to him. So this was happening before 2016. After 2016, the law got changed. Now we got specific formula what to be done when you are transferring and when you are issuing. So formula got changed. We'll discuss that formula in detail. So your 11 UA gives two things. When you are issuing, what should happen? And when you are transferring, what should happen? So if I am issuing, I need to take care of two important sections, section 56, 27B and Rule 11 UA. Most important, in 11 UA, there are many rules, 1, 2, 3. I need to specifically read rule number 2, because that talks for my issue. Rule 1, A, B, C talks about transfer. So here I need to only look for subsection 2. In case of transfer, I need to look for section 50 CA, 56, 210, 11 UA, subsection 1, and 11 UAA. 11 UAA always refer back to 11 UA1, but just for reference. Then we also need to see what section 50 CA talks about. 50 CA talks about what should be the consideration of fair value. If I'm transferring any shares, what should be considered as fair market value? Our standards of Companies Act and valuations always use word fair value. But if you look income tax, they always use the word fair market value. Income tax always have fair market value word. So 56, 210 and 27B are very crucial shares. It always comes in a challenge for buyers and issuers. What should be the definition of fair market value? How you should define in case of unquoted shares or in case of quoted shares? Certain specific rules have been defined. Majority of definitions are given in Rule 11U that talks about balance sheet, merchant banker, registered valuer. Their registered valuer means registered valuer who is registered under wealth tax for land and building and other assets. IBBI registered valuer is not recognized as of date in income tax. So this 11U talks about three important things: balance sheet, merchant banker, RV. So they say for issue of shares, what do you mean by balance sheet? Audited balance sheet as drawn up to the valuation date. So technically there is a problem. And why there is a problem? If I'm doing transaction today morning, so my morning transaction, I cannot ask him to get a valuation by tonight, because balance sheet will be drawn in the date. So valuation date ends at 12 p.m. So practically that's not possible. But then they give leeway where balance sheet is not drawn up to the valuation date. You rely on balance sheet drawn on the date immediately preceding the valuation date, which has been approved and adopted in AGM. So that causes a challenge to go back to at least 1.5 years back practically. But as I mentioned also, practically nobody follows this. We always go with last audited. So we go with March 2020 or March 21 in current case. In case of transfer, they are strict. Unlike issue where they give an exception, they have specifically mentioned audited balance sheet as on valuation date, audited by stat auditor. Issue can be audited by any other auditor. Here in transfer, it has to be stat auditor. And audit is not a one-day job. I need to conduct audit and it will involve cost and time. So practically for a small company, this is still okay. But for big giants, big startups or big unlisted companies, not possible. For quoted share, there is no challenge. Quoted share, you always go for listed data. Challenge comes for unquoted shares. So Rule 11 UAA talks about that for unquoted shares, you need to go Rule 11U evaluation. So Rule 11U talks about when it is unquoted, how to be treated. So it gives you three data for quoted, unquoted. Unquoted, there are two, either equity shares or other securities. It can be preference shares, CCPS, debentures, OCPS. So one is purely equity, then rest all other securities. What valuation to be done? So for quoted, it is very simple. Go through the stock exchange. As on that date, whatever is the price available, that becomes your transaction price. So that is easy. Quoted is not much challenge. Either be a equity shares or be a debentures or preference shares if they are listed. Challenge comes on unquoted shares. So if it is a unquoted security other than equity shares, so then they've given a formula. They've not given a formula, they've given a principle. So the principle they've given for unquoted securities, you may obtain a report. Here, may means shall. So for a For an assessee, may always mean shall. For department, shall also means may, because department can do whatever they want. So it is suggested for issuing CCPS or debentures, you should take a report either from a merchant banker or an accountant. So a CA can issue a report for issuing or selling unquoted shares. That can be, apart from equity shares, you can get a valuation. And what should be the value? So they're very subjective. Value means, they mentioned here, I'll just highlight what they mean. Value means the price it would fetch if it's sold in open market on the valuation date. So it is very subjective. So mostly CAs or merchant bankers do a comparable analysis and then try to issue a value, because it is subjective, not straightforward. So this is for other than equity shares. For equity shares, whenever I'm transferring unquoted equity shares, there is a challenge, and we need to follow this formula. Formula is A plus B plus C plus D minus L multiplied by PV upon PE. Now, what does it mean in sense? A means simply when I'm transferring shares, as on the date of balance sheet, if I have that balance sheet, take book value of all assets and reduce jewelry items, artistic items, securities, shares, investments, and immovable property. These things have to be excluded. Then I need to add jewelry at fair value from either well-tax valuer or artistic work from any intangibles or who works art and crafts valuers. For shares, we need to go for fair value, and the fair value will be, so I'm selling a share of a company. That company has further invested in unquoted company. In that case, I need to again follow the formula A plus B plus C plus D minus L and get a fair valuation. Then if I have an immovable property, minimum price should be what is my stamp duty rate. So if my circle rate for transaction purpose, if I can get that value, that becomes a minimum value for me to do a valuation. Now here the challenge is, the biggest challenge in this is, what is the layer of company I should go? Suppose company A has invested in company B, so both are unquoted. Company B has invested in company C. How to get a valuation done of those shares of B and C? If I'm 100% holding of A, B and C, I can still demand. But if I'm minority, how can I follow this formula A plus B plus C minus L? So practically that is a challenge. Department has not given any exception that up to how many layers you go. It can be 2-3 layers. It can be 10 layers also. So it becomes big challenge, and especially in case of family-owned companies, the layering is very high. So this becomes a huge challenge. So that is on asset part, A plus B plus C. Then it goes for liabilities. So we need to reduce liability. So what it says, take entire liability, but out of this, remove paid up capital of equity shares, remove all dividends you need to pay, remove reserve surplus, remove depreciation reserves if you have made, remove taxations provision you have paid, remove any provisions made for contingent liabilities that should not be part. Then whatever resultant number comes, multiply with paid up value of each shares and total share capital. So this will give you a fair value of the company. So this is the formula which normally used in case of So I don't have any choice. This is my minimum benchmark. I can go for higher valuation, but minimum it should be A plus B plus C plus D minus L. Now, what is the challenge in this formula? It does not support startups. So if any, it will be a funny situation. Let's say if Zomato wants to issue shares, they might have a very high number based on issuance. They can do a DC valuation. But if I want to sell, I can use this law and get the minimum number. Because to sell, they don't have intangibles. Startups don't have intangibles, or they don't have immovables. So startup immovables are nil. So my asset value will be very low. The government is working on this, and they might have get a new law very soon on this. So all fair value has to be from registered valuer, who can be from Wiltex or any other respective law. If Wiltex have not registered them, a challenge comes, which is a practical challenge. My actual sellable price of immovable property is way less than stamp duty value. It may happen that my stamp duty is coming very high, but practically I'm not able to sell that property at that price. Should I take actual sale consideration if I'm getting for selling immovable property, or it should be minimum stamp duty value? Here it is unfortunate. It has to be minimum stamp duty value. Even if we are not able to sell at that price, I cannot take a leeway and say this is practical consideration. Department will not accept it. So this is the formula we discuss in more detail, A plus B plus C minus D, and you need to write the number. So in transfer, we have only this formula. Do we need to mandatory take a report from chartered accountant or a merchant banker or any valuer for getting this number? So technically, it is not required. For transfer, even a management working can do fine, because it's a calculation assignment. It is not a valuation assignment, because you are just taking numbers and punching it and getting it. You are not doing any fair value. You are just using circle rate or other things. Now comes issue. In terms of issue, the rule says the fair value can be, see clause 1 and clause 2. Interesting part in clause 1 and clause 2. Clause 1 says for issue of shares, you can take value as per methods prescribed. So there are two methods, DCF or net assets method, two methods. Now most interesting point comes after that, or as may be substantiated by the company to the satisfaction of the assessing officer. So I have a choice to go more than this formula, either DCF or net assets, or I can go any other formula where I get a higher value. So that is there. So what I have two methods. One, straight away, I can either take a fair market value as per the formula, that is asset minus liability at plain level, or DCF. This is my choice. Assessee can choose whatever method he wants. Department cannot question him why you are not using DCF or taking low choice. That is not department's call. What is the formula given in case of issue? See the important difference. Earlier it was A plus B plus C plus D minus L. Here it is plain vanilla, asset minus liability. Here I am not required to do a fair value of immovable property. Unlike in case of transfer, where we need to do a fair value, here I can take everything at cost or book value and can arrive the formula. So this is the A minus L or DCF approach. A minus L report can be taken by a chartered accountant. So any CA can give this report. But DCF report for issue of shares has to be only merchant banker in income tax. So here comes the big challenge. In Companies Act, for issue of shares, a client need to get a registered value report, and in case of income tax, you need to get a merchant banker report. So many a times, small company says we only want a net assets method, so merchant banking report is not required. So that is the way they try to avoid. Now comes a interesting U-turn of department. So what was happening if my fair value of share is coming 100 and I issue at 115. So 15 rupees was getting taxable. And in case of recipient, if my fair value is 100 and I'm issuing at 80, so it's a fresh issue. Rule 11 UA value is giving 100 and I am issuing at 80. So a department raised a dispute that this 20 now should be taxable in the hand of recipient. If my fair value is 100 and I'm issuing at 115, I tax it at the hand of issuer. But in the reverse case, let me tax at the hand of holder. Then department gave a circular that no, this does not apply on fresh issue of shares. It applies only on transfer of shares. So everybody was very happy that department gave a circular, but this happiness was short-lived. They issued another circular very soon, in a month's time, and say, and I see the way department writes, views stated in this circular as considered to be never been expressed and accordingly should not be relied. So today also there is a challenge that if I am fair value of my shares is coming 100 and practically company is able to find investor at 80 rupees only, should the 20 be taxable in the hands of holder? This is a dispute still going on. It has not been concluded. Now, few gray areas: deferred tax assets and deferred tax liabilities. Should we consider them as an asset or liability in considering the valuation? There are again no settled view on this. Different consultants and different big firms have different views on this. I know specifically two big four firms had a view that DTA should not be considered and DTL should be considered. Other firms is both views should not be considered because they call it as a fictitious asset, or they say it is not a realizable asset. So department has not yet given clarity, but in case of MAT credit, it is settled view, because in one of the income tax cases, it was decided that in case of MAT, it will be a deductible item or it is an asset. So that is views cleared. Since Indies have came in, what treatment for interest-free loans? Because in case of interest-free loans from holding or subsidiary, we create investment in equity. That kind of treatment we do. So Rule 11U has not been updated because of any Indies adjustments. So that causes challenge, because department will only go what is written in 11UA. So department have not even looked into income tax amendments. of related to Indies. That is a challenge. Another big challenge in Indies in Rule 11 UA is, so if I have a CCPS or CCD, where the terms are, this will be exactly converted in 1:1 equity. So my equity is fixed. I know it will be considered an equity. So typically CCPS ideally should have same value as equity if I am having a conversion option clear. But in 11 UA, I can have two different values. For equity shares, value will be different. For CCPS, value will be different because formula is different. What to do with right to use assets? Now in income tax in India, if I'm having a lease of any item more than 1 year, I need to record it as a right to use asset. So should it be considered in my assets or should it be ignored? Because it may happen my right to use asset and lease liability will always have difference amount. They cannot be exact same to same. So that is a challenge. Another challenge is differential voting rights. If I have certain shares who have a special voting rights, their valuation is different, but that is not captured under Rule 11 UA. Also on partly paid up shares that have also not been captured, specific guidelines is not there. Another gray area is investment in partnerships. So this question for all who would like to give some views on give the views. A company invested in a partnership firm. So we are talking of a case where there is an unquoted private company. That private company invested in a partnership firm. Partnership firm invested in huge land bank. Now, the land which was invested by partnership firm was 1 crore rupees. Today, when we are transferring the shares, that value of land went to 10 crore rupees. It's a market value. We are still recording in books at 1 crore, but market value is 10 crore. Now for transfer of shares, do I need to fair value the land as per Law 11 UA mandatory or no? What is your view? Yes, no, maybe. If I am able to put question correctly. We are transferring shares of private limited company. That private limited company has invested in a partnership firm. That partnership firm has huge land bank. Should we take land bank at cost or I need to do fair value as per 11 UA? Any thoughts of any participant? Yes, no, maybe. What do you think? Now, so this is the most gray area. Technically, I am not supposed to do fair value of that immovable property. So I know I'm confusing you. So at one point of time, I said it should be A plus B plus C plus D. I should do a fair value. But here I'm saying if a private limited company has investment in partnership firm, you are not supposed to do fair value of that partnership firm. Any reason why I'm making this statement? There has to be some logic for this statement. Why? What does 11 UA talks about? To do a fair value of shares and securities. Investment in partnership firm is your equity shares or securities? Yes or no? If we clear on this answer, we get the answer clear. So investment in partnership is not security, nor it is a equity share. It does not fall into that category. It is just my right in that partnership firm. So this is a loophole. A lot of big organizations have used this loophole. They put assets under partnership firm because can I sell my partnership share? You either retire, admission or dissolution or retirement. Do I have a right to sell? Think logically. Do I sell my partnership? Practically, I may be taking cash or doing assignment in his favor. But what happens in partnership firm? You exit and another person enters. So you do not have security or share. And 11 UA talks of only fair valuing shares and securities. So investment in partnership firm is out of it. There is a 2-3 case laws on this, and a lot of tax planners have used this. Last gray area is on step down layering limit. So as we discussed, A invest in B, B invest in C, C invest in D. At what point I need to stop? That is not there. I know one of my valuer friend, they went up to 96 companies in step down layering. It was a Delhi based big group. A invested in B, B, C, and the ultimate land bank was a 96 company. You cannot stop at one place and say that limit is up to 5 or 10. So that was a challenge. So this department is not mentioned. Now I'll take 2-3 questions, or 2-3 case laws, and I'll take what are the questions pending. So who has a right to choose method? That was clearly established in Karmic Labs versus ITU. They say department cannot push client to choose what method. It is assessee's choice. You want to go for net assets method, get a lower value, or DCF, get a higher value. It is his choice. You can always, department can always check the assumptions, check the method, but you cannot dictate that which method you should take. Another interesting case law, which was again approved by High Court also, Cinestan Entertainment Limited versus ITAT Delhi. So in this, it recently passed in High Court last month. In this, Rakesh Jhunjhunwala, Radhakishan Damani, and big investors made some investment in startup. Investment was made at a very high price. Loss-making company, 2,000 rupees fair value. That was the investment per share they did. The startup used DCF method. When the department checked the method, that method projections did not tally with the actuals. Because after 2 years, if you check, you always have next 2 years balance sheet. They reviewed the balance sheet and they've checked that the projection did not even match 25%. So they rejected the DCF projections and say valuation is wrong. Then the court made an interesting observation, and see what court say, that these investors are not related, and do you think these investors will just make investment to do a charity? They are seasoned players and commercial prudent, and they would invest only when they think they can arrive value in future. So that was in a good favor of projections and valuers. The department cannot compare future projections with actual numbers, because in this judgment they also quoted future projections are separate, having them achieved is separate, because macro and microeconomic factors can change the entire achievability of projections. So you cannot question the valuer that projections have not been achieved. What you can question valuer is the assumptions on which it was made. Have you verified those, at least on some test basis? And if valuer can justify, you can always take it. Now, one last question I'll ask before we conclude on, before I take your questions. So in case of issue, there was a 2 formula we have discussed, asset minus liability at book value or DCF method. But suppose client says, I have a land in my books, and land book value is again 1 crore. Fair value of the land is 10 crore rupees. Why should I value my share at 1 crore? Why should I give benefit to the incoming for last 5-10 years which I invested my money? So I want to value the land at 10 crore rupees while issuing shares. Though the formula says asset minus liability book value. Can the valuer for issue of shares use 10 crores book value, fair value of land? Yes, no, maybe. Any thoughts on this? Yes, no, maybe. Can he use or he cannot? Because formula says A minus L book value or BCF. Client has a practical demand and a reasonable demand. Why should I give the incoming party value of cost? Because I would have bought land at 5 years back. Let me get the benefit of it and issue shares at 10 crore rupees fair value. Can he do it? Yes or no? So this makes practical sense to ask, and client did it. Assessing officer rejected it. Assessing officer said that you are using asset minus liability method. You cannot take land at fair value. So I'm rejecting this method. It went to tribunal and it was finally decided in the NUB Multitrade. This was a Jaipur-based company, and income tax ITT in October 20 admitted that you can use the land at fair value, because what does the section 50 says? Either any of the methods, asset minus liability or DCF, or any other method which can be substantiated to assessing officer that this is a fair value of land, because the valuation was done by registered valuer of Veltex, who gave a value of 10 crores. Department did not objected the valuation fair value of land. They objected on the method, so which was quashed by department, and this can be used for your clients also. If you can justify fair value of land, you don't need to go asset minus liability. So this was all from my side. I thank you all for a patient hearing. Let me quickly take back the questions. There are some questions. Let me take. How to determine cross holdings? This is the most challenging part. You can only determine cross holding by using simultaneous equation in Excel. In income tax, there is no such requirement. Like there is no such formula. They have not given anything, which is again a gray area. Question of what should consider preference. Now, department do not consider Ind AS concepts. So what we follow, substance over form, department follows only form. So if you have a convertible preference shares, they will still consider as a part of equity. Even if it is a redeemable preference shares, department will not consider as a different. So they have a little bit Ind AS orientation they don't have. The transaction date is November, and prefer to use 31st March or 30th September. Okay. Okay, Mr. Anand, in this case for transfer, I will always go for 30th September unaudited balance sheet, always for a transfer, for a simple reason. The law says go for audited balance sheet on the date. That is not available, so I will always go for the nearest available, because 31st March balance sheet and 30th September, if there is too much variation, it will become addition in my report, in my taxability. So always advisable to take 30th September. So on a jokingly, it's on a lighter note. We always say, "Jahan Satyanash, wahan sawa Satyanash." Already, I'm breaking the rule. My rule is it should be on the date of transaction. If I'm not having that, then let me take unaudited nearest balance sheet. This is what personally I do, and even after taking views from very seniors from different areas who work in taxation from so long, they said this is the best practical. I can always go and defend in tribunal this 30th September balance sheet. 31st March would be too long. That's my takeaway. Let me take one more chat probably, I think, regarding the land. Yes, absolutely, Badri Naranji. You can always do that. Specifically in this case, it happened that they have taken all other asset at cost and land at fair value. So there's a nub multi-trade. If you Google this, like it's a good case study. And just to give you a very interesting observation, we have just 2 minutes left. In this nub multi-trade, when the department rejected his methodology of taking land at fair value, this guy went to merchant banker and said, get me exact same value. Merchant banker gave the same value also. Now department rejected DCF also. And why department rejected? They say first time when you gave a report that was of asset minus liability, not DCF. So we will not consider DCF. So court said there is no need to even go for DCF. We can go with your fair value of land. So that was acceptable. So this judgment proved benefit for a lot of people, and logically it makes sense. If I'm having an asset fair value more, why should I give benefit to incoming person at a lower price? If anybody has any points, and just to for all the participants, Badri Naranji is from Coimbatore and one of the most dynamic professionals. I had opportunity of visiting Coimbatore and meeting him. So our session was from morning 9 to 5:30, and from morning to evening they were fully charged up. And he is always participative at all places. So I can see some good friends, Nitish and so many other participants. And see, valuation is always subjective. And these case laws always come to help. I'll give you a very interesting case law. I cannot give you the name because we are going into tribunal with one Delhi firm. How the department behaved stupid. And let me openly say this word. 11 UA we discussed. My fair value of 11 UA for transfer is coming 200 rupees. So that is fine. 200 can come. Party sold at 500 rupees. So if I am able to sell anything at high, department should not have a problem. They raised a notice. The assessee sold at 500 rupees and his cost of acquisition was 10 rupees because it was initial. The case was raised against the query that seller, your fair value is 200. So for capital gain purpose, 50 CA, we will only consider 200. The rest 300, that is 200 from 11 UA and 500 actual transaction, we will consider that as income from other sources, which is totally insane because my client lost because of 50 indexation benefit. You cannot use this logic. They lost at commissioner. Now the department went to ITAT. They will again lose there. But I'm trying to tell you the points. Department can always work what they want, but we need to follow the law to the best possible way. If anybody has any questions to ask or like to contribute, we would be happy to listen. So anybody else can get benefited. Nitish, if you like to have some views. Nitish is the first registered valuer of SFA category from ICA Argo. Nitish, you like to Nitish, you want me to unmute you if you like to say something? Because I get bored by hearing myself, so I need to hear new voices.
Good evening, everyone. Hi, Sumit. You have very well explained all the provisions. Just one thing I just want to add in this, that in case there are number of layers, then although there are no restrictions, but the general practice is that we don't go beyond 2 layers. But as you have very well explained, that since the asset is there in the 96th entity, so we have to drill down till the last entity. But as a general practices, we follow only till 2 layers of enterprises. And in case of subsidiaries also, there is a restriction that you can't have more than 2 layers for Indian entities. You can have more than 2 layers for foreign assets as well, but sometimes there is the subsidiary holding relationship is not there. In that case also, we restrict ourselves to 2 layers.
A lighter note, Nitish, I always say, हमें फीस कितना मिल रहा है उसमें हम रिस्ट्रिक्ट करते हैं. कम मिलेगा तो हम फर्स्ट लेयर पे भी रिस्ट्रिक्ट कर देंगे. 96 का देगा तो 96 हो जाएंगे.
The real problem arises in case of M&A. There are cross holdings also. Suppose for a group you have 40 companies and the ownership is among the 40 entities. There is no holding subsidiary relationship. All the holding of all the entities is within the group itself. In that case, it becomes very, very difficult how to eliminate, which one to eliminate first, and that needs to be, there need to be some guidance for that.
Absolutely.
The structure is very, very complex. You have 40 entities within the same group. All the holding is within the same group, and then you want to merge few of them. In that case, it becomes very, very difficult how to eliminate, which one to consolidate first, which one to consider for valuation first.
In fact, if you ever watch Ashwat Damodaran, he made a public statement. He says, I can value any company, but when it comes to Indian group holdings, I cannot value Tata Holdings, I cannot value Birla companies, because it is interlinked. A into B, B into C, C into again A. So it's a huge chain reaction. So that is actually difficult.
Right. Yeah, that's it from my side, Sumit.
Thank you, Nitish.
Very well explained. The entire presentation has been very, very wonderful.
Thank you, Nitish. Mehak, if you have anything to mention, can take up else.
Yes, sir, that was a great session indeed. And I'd like to extend our vote of thanks on behalf of All India Institute of Valuers Foundation to you for sending across your knowledge on the 2 topics, that is CLD and valuation under income tax. I'd also like to thank the participants for their presence today. Moreover, for making this webinar interactive by raising all the questions and all the queries. Now, as we come to the end, I would like to request you all to take a note, all the participants, that the certificates and the video links both would be shared with all the participants shortly, most probably within 2 days. And as we depart from this webinar, I'd like to end with the same quote I started with by Nelson Mandela ji. Education is the strongest weapon one can use to change the world. So let us try to gain more and more knowledge to sharpen this weapon with every passing day. Thank you, sir.
Thank you. All have a good day. Thank you.
Thank you.